Hello and welcome everyone. Thank you for joining our first time home buyer webinar. Today we'll walk you through the essential steps and considerations for purchasing your first home. Next slide. Here are the key topics we will cover today. First, we have why buy a home. We're going to break down the true value of home ownership, not just financially, but emotionally, and for your long-term stability. Whether you're comparing it to renting or thinking ahead about building wealth, this part will help you understand the big picture. Next, we'll also cover, back up, yep. How do you know if you're ready? We'll walk you through some key indicators from financial readiness to life circumstances. And we'll talk about the mindset it takes to become a homeowner. How to get a home mortgage loan. This part could feel overwhelming for many buyers, especially first-time home buyers, but we will simplify the process here. You'll learn what lenders look for, what documents you need, and how pre-approval can boost your buying power. And finally, what is the home buying process? Step by step, we'll guide you through everything from searching for homes to writing offers, inspections, appraisals, and all the way to closing day. All right, next slide. So before we officially get started here, I want to take a moment to introduce myself, and also join us is Johnny Vang, a realtor mortgage broker with Win-Win Financial. I'll have him introduce himself as well, so you guys get to know us a little bit better. So my name is Seng Thao. I am a licensed realtor with eXp Realty. I've been in real estate for 3 years. I began my career in Milwaukee, Wisconsin. Last year, I made a move to Minnesota, which inspired me to expand my reach to get licensed here as well. Today, I probably serve clients in both Minnesota and Wisconsin. Throughout my first few years, I have had the honor of helping many first-time home buyers purchasing their first home, and that's become a true passion of mine. I'm here to make sure that no matter where you are in your journey, whether you're just getting started or getting ready to write an offer, just want to make sure you feel informed, confident, and supported every step of the way. And when you are ready to purchase your home, yeah, Johnny, you want to introduce yourself here?
All right, yep. So I'm Johnny with Win-Win Financial. Win-Win Financial is a mortgage brokerage up here in the Twin Cities. We do traditional financing, anything from conventional FHA, VA to DSCR type products. We do it here in Minnesota, and then we also do it out in Florida for the DSCR products. We do it across the nation, right? So pretty much everywhere on inside of the United States. We don't do much in Alaska or Hawaii, but we can definitely get you connected. In addition to that, I'm also a realtor out here in Minnesota in the Twin Cities area. We help tons of clients look for homes, help buy homes, help sell homes, as well as build out new construction. I've been doing mortgage for about 20 years, and I've been in the real estate industry for about 10. In addition to that, I'm also an investor. And so we, of course, have my team and we bought homes, flipped homes. I mean, you name it, pretty much the whole gamut. We have wholesale lenders and everything, or wholesale um, uh, salespeople who look for wholesale properties as well. And so we're very well connected here in the Twin Cities, and of course can help with pretty much anything that you need related to real estate. In addition to that, we're still working on, getting to know more people, more professionals, attorneys and title companies and so on. So if you have questions, reach out. We definitely are connected with, insurance companies and so on. So that's a little bit about me.
All right, sounds good. Next slide. All right, so first off, we're going to look here is why homeownership matters. And one of the most powerful reasons to buy a home is equity. Equity is simply the difference between your home market value, and what you still owe on your mortgage. So the formula that we like to use here is market value minus mortgage balance, which equals equity. So think of equity as your personal wealth. As your home value increases over time, and as you pay down your mortgage, your equity grows, and that equity can later be tapped into major life goals, like starting a business. Um, if you want to become a real estate investor, you can invest it into another property. Or if you have kids where they are attending college, you could use it towards college tuition. So next is, here's a big stat that I want you to see here. So according to the National Association of Realtors in 2025, the average net worth of a homeowner is projected to be $430,000, while for renters, it's only about $10,000. That's a $420,000 difference in long-term financial security. Why is it such a big gap? Because when you rent, you are helping your landlord build equity and not yourself. Your monthly payment is covering your landlord's mortgage and increasing their wealth. But when you own, you're the one that's benefiting. Even if you're paying down your mortgage slowly, the home itself is likely appreciating in value. That means over time, your investment grows even without you realizing it. All right, next slide. Benefit of homeownership is control and stability. It gives you something that's hard to get when you are renting. So let's look at the renting side first. When you rent, you usually can't make any major changes to the property. You can't remodel the kitchen, replace flooring, or even paint without your landlord's approval. And even that, it might not even be allowed. Rent is never guaranteed to stay the same. It can and often does go up once once your lease renews. And probably the hardest part is you could be forced to move, right? If your landlord decides to sell the property, or maybe for whatever reason your landlord doesn't want to renew your lease, that can be stressful, especially if you love where you live. Now let's flip that to owning here. When you own your own home, you are the one in control. You can renovate, paint, even upgrade appliances, anything that fits your vision. Your mortgage payments stay the same for 30 years if you have a fixed rate loan. That gives you long-term financial stability and predictability here. And you decide when you move. There's no surprises. No one can sell the property out from under you, right? Because it's yours. This kind of control stability isn't just about convenience. It creates a peace of mind. And for many people, that's priceless. Right, next slide. Let's talk about another powerful reason to own a home, which is tax advantages. When you rent, your monthly payment help you live comfortably, but that's about it. There are no tax deductions for renters. You don't get to write off rent payments on your tax return. But when you are a homeowner, it's a different story. The IRS offer multiple tax benefits that can save you thousands each year. Here we have three major deductions example. First off is mortgage interest. This is one of the biggest. You can deduct the interest you pay on your mortgage each year, which can be a huge write-off, especially in the early years of the loan when your interests make up a large portion of your payment. And then there's property taxes. Homeowners can also deduct property taxes they pay each year, which helps reduce their taxable income, which helps lower their overall tax bill. And then last we have here is depreciation. Now this one mainly applies to investment properties, but if you ever decide to rent out your home, or if you later down the road own additional properties, you can deduct depreciation over time, which is just another way to maximize your return. So while renting may feel simpler upfront, homeownership often comes with big time tax perks that renters don't get to enjoy, and that's real money staying in your pocket. All right, Johnny, you want to take it from here?
Yeah, yeah. So thanks for that portion. That's uh, super valuable, right? Valuable information. When you own your home, there's way more benefits than if you actually rent. Now, I mean, of course, if the rent is super cheap, like if it's $500 a month and the only mortgage that you can get is going to be like $2,000 a month, then renting has its benefits. But the honest truth is, when you own your home, the buildup of equity and the items that Seng was talking about definitely helps out significantly. So, since I'm a mortgage expert, right, we're gonna be covering some of the items that you need to get ready to buy a house, right? So the question is, are you ready to buy a home? First of all, right, as lenders, we're gonna be looking at your credit. We're gonna be wondering where your credit score is. We're gonna be wondering, like, are you making your payments on time? And with that, right, the minimum credit score or FICO score for FHA loan would be 580. Um, I mean, if you look at the list here, you see it go from exceptional at the very top to very good, good to fair, and then to poor, right? And poor, like anything below 580, is pretty rough, right? You're in pretty rough condition. But if you're at 580 and you have all of your monthly payments are caught up, you don't have any collections left over, and you just had some late payments in the past, and now it's been, maybe a year or two. The likelihood is we'll be able to do something with you, right? Be able to get you financed under the FHA loan process. In addition to that, I think conventional is actually 640. We have 680 here. And the reason we have 680 there is because you want that better credit score to be able to get a better rate, right? So usually you can get a better rate with a higher credit score for the most part. Um, so if you are caught up with all of your bills and you're able to, make a rent payment, the likelihood is that you should be getting close to being ready. Um, and so next, we're going to be going into the debt to income ratio, right? Are you ready to buy based on your monthly income, right? Based on the expenses that you have, right? So what we do is we take your total debt, right? And we divide it by your monthly income. Now that total debt, right, would include your student loans, your car loans, your credit cards, installment loans that you might have out there, as well as any other mortgages that you're covering. Like some people, they co-sign for their mom and dad for their house, right? And that shows up on the credit report, which then we have to then consider it in the debt to income ratio, unless the mom and dad truly does pay it and have been paying it for, like, like the last 12 months. Then you might be able to exclude that from your debt to income ratio. But of course, you want to talk to your loan officer about that. So what we do is we take any debt, right, that you have added to the new mortgage amount, and then we divide it by your gross monthly income. That's how we come up with the debt to income ratio. Monthly debt, again, mortgage and student loans, cars, any other loans that you might have out there. How you determine your gross monthly income is if you're a W-2 employee you take your hourly wage, multiply it by your 40 hours a week, multiply by the 52 weeks, and then divide it by 12. And that's how you get your monthly amount. If you don't work a full 40, then of course you use whatever it is that is your weekly check and then multiply it by 52 weeks. Now, reminder, that's gross income, right? So we're not talking about what deposits into your bank, but actually what you receive as an hourly wage before you get taxed. So as long as your debt to income ratio is below 50%, you could pretty much you're gonna be good, right? You're gonna have enough income to qualify. The lower the debt to income ratio, the better it is. In addition to that, if you go above 50% debt to income ratio, it becomes a little tougher for you to get finance. If you do FHA, sometimes we can go up to like 55, 57-ish, but it's much harder to underwrite and much harder for us to find compensating factors to make those things happen. So you want to stay below 50 if at all possible. Um, so in addition to your having your credit ready and having your income ready, you also want to have money in the bank, right? Buying a home is easier if you have money in the bank. Now, if you don't have any money at all, sometimes there's down payment assistance program out there that will help cover things, and we'll get into that in a little bit. But if you don't qualify, for example, you make too much money, but you just don't have any savings, you're probably going to want to come up with a minimum of 3 to 3.5% to be able to qualify if you're a first-time home buyer. First-time home buyer meaning haven't owned a home or haven't co-signed a home in the last 3 years, right? So you want to have that 3.5%. You want to have your closing costs of the 2% of the purchase price. I think this is going to be dependent on location. Maybe in Milwaukee, we're looking at, somewhere between 2%, maybe Wisconsin, right? In the Twin Cities here, insurance and taxes have increased pretty significantly. So you're looking closer to like a 3.5 to 4% in closing costs. So just be prepared to have both your down payment and your closing cost. So you're going to want to try to save at least 5 to 10% of the actual purchase price to help you qualify for the loan from a savings perspective. Again, unless you're using some kind of a down payment assistance program. Um, so how do we determine that? You take the purchase price. Let's say the purchase price was $200,000. You multiply it by the 5%. That's $10,000 that you're going to need, right? And if you need 10%, here's an example for 10%. If the house is $200,000 and you're going to multiply it by the 10%, that's $20,000, right? So it adds up pretty quickly, but you're going to want to make sure that you have enough to cover for both your down payment and your closing costs. And of course, there might be other fees out there, such as home inspections or surveys that you might have to do. It just depends on the type of property that you're going to be buying, right? Secondly, if you don't have cash, right? Or if you do have cash, right? Say, for example, you have $5,000 sitting underneath your mattress, right? You're going to want your funds to be seasoned before you go to the bank and ask for money or go to a lender and ask for money or a brokerage like myself. You're going to want to deposit those funds and then have at least a 2 month seasoning on it before we can actually utilize it. If you just throw cash into a bank account or if you tell us that you have $5,000 just sitting in your mattress and that's what you want to use for your down payment, we're gonna have a tough time getting you financed. So just make sure and some lenders don't even finance you at all, right? So just make sure you get that deposited as soon as possible or talk to your loan officer and they can give you an idea of how to handle that. And then in addition, right, we don't want to see large deposits, and large deposits usually means 50% of your gross monthly income, right? So let's say for example, you make $3,000 a month in gross income. We don't want to see anything more than $1,500 going into your account a month. Anything beyond that, The underwriters are going to question. They're going to wonder where you're going to getting your money from. You're going to have to explain. If you can explain, that's fine. We'll take a letter. We'll like say for example, you received uh, some trust funds from someone passed away and you receive some money. As long as we can trace it back, it'll be fine. But if it's cash, we can't use it. So just understand that large deposits are harder to document. We try to get that all fixed up and prepared for underwriting prior to you coming and getting a loan. So we try to get that all seasoned before we can make sure that you qualify and qualify well. In addition to that, you can use gift funds, right? So let's say your mom and dad has like $50,000 they can just give you to help you buy a house. That's amazing, right? So the thing is that it can't be in cash, right? Because again, we need the funds seasoned. So what we can do though, however, is if your parents do have $50,000 and they're the ones that are going to be writing it, you can use that for your down payment and your closing costs. And so usually what you're going to want to see, I know it says here that, you can either do it, send it over as a check or a wire directly to the title company. My recommendation is use a check, right? And that comes from years of underwriting, right? Because I was in underwriting for a while being in mortgage. You want to do the check because the check allows you to know exactly who the donor is, know exactly where it's coming from. It gets canceled, right? So once the funds actually move, the check gets canceled. You'll have a copy of that canceled check. And as long as you have the back and front of the check along with your gift letter, you're pretty much going to be set, right? If you do a wire, it's a little bit harder to document all of that. If you do any kind of other transfers, it's going to be harder. So you want to try to do a check if that's if at all possible, right? So you can definitely use cash or you can definitely use gifts as a down payment or closing cost, but cash, it has to be seasoned. Okay, so now we're on the down payment assistance programs, right? First of all, everybody in every state has their own products and programs, right? In Wisconsin, I know they have down payment assistance. In Madison, I had a relative who used a down payment assistance program. They gave a super low interest rate on the second mortgage, and it worked out really, really well for them, right? Here in the Twin Cities, we have the first generation home buyers down payment assistance program. And then we also have Minnesota Housing, right? And then of course each city has down payment assistance, but the reason you have to ask your lender is not every lender carries or can use every down payment there is out there. For example, us at Win-Win Financial, we only carry the first gen product, which is a possible $32,000 forgivable loan, or we carry the Minnesota Housing, which is an $18,000 second mortgage, which in some cases can be forgivable, in some cases it's not forgivable, but it is a mortgage and you do have to make payments on it, right? So these products, they all have income, uh, household guidelines to buyer's education guidelines to pre-approval guidelines. So I want to show you guys the first gen program, right? So I want to explain a little bit about that. So I'm from Minnesota, so we carry this product. Now, this product, you have to come to us as a lender first. Then we have to pre-approve you, right? And after we pre-approve you and we determine that everything else qualifies except for the assets, right? Then we're going to give you a pre-approval letter with the exception that you get this first gen program. Then you can go to this place and check and apply to see if you're eligible. Right now, I know there's a lot of talk out there and people are saying that they're out of funds, but the truth is they're still accepting applications. This is current on their website right now. And so my recommendation is get yourself pre-approved and then apply, right? See if you're eligible. There's a bunch of qualifications, right? You just click the apply now, and to see if you're eligible, you got to do a home buyer's education. You got to get that pre-approval from us. Then you got to apply for the program. And then once you apply and they approve you, which could take anywhere from 6 to 8 weeks, right, to get you approved, Once you're approved, then you can start looking for a house. And so you want to go through the process as fast as possible to try to get yourself pre-approved and so that we can go through this process. This is a super helpful program for those that are first gen. Like for example, in this program, right? The question is, like how do you qualify for it? Well, your parents can't own a home. You can't own a home currently. And if that's the case, then you can qualify for the program, assuming you meet the income limits and all the other requirements, right? So here in the Twin Cities, right? So I do a lot of Hennepin and Ramsey County, as well as Washington and Anoka. Um, this is your max income for all the borrowers, every single one of the borrowers inside of that house, right? So if your parents are going to live with you, we're counting their income, right? So if your income exceeds 124,200, you don't qualify. But if it's under that, of course, there's a lot of us that, don't make this much income. So if we do qualify, then that's perfect. We can qualify for the program, assuming we meet all the other eligibilities, right? So again, there's a bunch of eligibilities, requirements. Make sure you talk to your loan officer about that. Secondly, we have the Minnesota Housing Step Up and Startup programs. They also have income limits, right? So you're seeing the income limits here. Um, in addition to debt to income ratio guidelines, down payment requirements, that's all required, right? Like, so for example, if you're going to go through an FHA product, right, a government FHA product, your minimum FICO is going to be 650. And if you're at 650, the max DTI you can get is 45%. If you're at 660 and above, then you can actually go to 50% debt to income ratio. And that includes, right? That includes your first mortgage, all of your debt, plus this second down payment assistance program. So that's just a few rules that I wanted to point out. Make sure you guys are aware. There are down payment assistance program out there. A lot of people think that they all qualify for it, but not everybody qualifies for it. Best case scenario, come in with 3 to 5% and come in with another 2 to 5% closing costs and be prepared for those things in case the down payment assistance doesn't actually work out for you. So whether that's to get a gift or whether that's to, borrow against your 401k, all of those things we can do. Just talk to your loan officer. They can go over those items with you. If it doesn't work, you have multiple choices to go to different lenders to see what the different possibilities are. I myself, because I'm a realtor and a loan officer, I don't always do the loans on all of my clients. Sometimes they're better off going with, let's say, for example, the builder's lender, right, to get a $20,000 credit or something like that. Then we take them down that route. If there's a down payment assistance program out there that helps my clients better them, then we take them down that route as well, right? So as a loan officer, we try to do our best to make sure that our clients are taken care of to the best of their ability. Okay, so what's required to get a pre-approval? Um, First of all, you need steady income, right? So that means that you have to have a minimum of a 2-year history of working. Now, it doesn't necessarily mean that all those 2 years you have to be working at one specific job, but you at least have to have at least 2 years of job history or have been going to school and then transitioned over to your career position based on, let's say, for example, you went to school to become a doctor and then you finally got the contract to become a doctor, then we can use your school to support the new position that you're in, right? And so you're going to want kind of a 2-year history, 2-year W-2s. If you're self-employed, you're going to want 2 years of proven income on your tax returns. And so just so you guys know, from a self-employment income perspective, we're going to be averaging that. And so say, for example, you made 50,000 in 2023, and then you made 100,000 in 2024, and now you want to try to qualify for a house, we're only going to be able to use 75,000, right? Because we're averaging it. So based on an annual basis, right? So just know that you're going to need that if you are self-employed and you file 1120S, right? So you're an S corp. We're going to need your K1s. Same with if you have a partnership, right? So make sure you have all those documentations ready to go for that pre-approval process. So for down payment, again, somewhere between 5 to 10%, have those funds ready. Whether that's going to be coming from a down payment assistance program or from your pocket, or and when I say pocket, I mean from your bank account, right? Not literal cash, right? Or a gift. And then third, you're going to want a credit score over 580 to be able to qualify. The higher the score, the better from a rate perspective. And then finally, you're gonna have to provide, 30 days worth of pay stubs, 2 months of bank statements, 2 years of W-2 and maybe tax returns. You're gonna want to provide any other information that might be able to help us as lenders help you get qualified. Definitely, we will need your IDs as well. So we typically ask for the front and back of your IDs, and we pretty much take it from there. And then if we have any questions about anything else, we'll ask for it. Say, for example, if you're going to school, we need your transcripts from school, right? And it's okay if you didn't get super good grades. We just need the transcript for the history. And then next up, I think this is where Seng's gonna pick back up and help you guys through this.
All right, thank you, Johnny. Lots of good information there. So if you are in Minnesota and are looking to purchase, get in contact with Johnny with those down payment assistance programs. So yes, next let's talk about what it actually looks like to work with for a realtor. And I'll also go over a few common questions that first-time buyers usually have. First, here, let's look at does it cost anything? In most cases, the answer is no. As a buyer, you typically don't pay your realtor directly. Traditionally, the seller pays the commission for both the listing and the buyer's agent. That means most of the time, as a buyer, you don't pay anything out of pocket for your realtor services. We will help you search, schedule showings, negotiate, and handle paperwork at no direct cost to you. And then buyer agency agreement. Now here's where things have changed. So starting as of August last year, 2024, due to recent settlement by the National Association of Realtors, all agents working with buyers must now have a signed buyer's agency agreement in place before we could start showing buyers any homes. And in this agreement, it outlines how we will represent you, what services we're providing, what our current composition is, and how that will be paid. Often it is still paid by the seller, but not always. The key thing to know is you will know upfront if there's any costs or if it's covered by the seller. Nothing is hidden anymore. The new rule is all about transparency and clarity. So basically, the buyer agency agreement is a legal agreement that formalize our working relationship, right? It outlines what your realtor will do for you, how long you will work with your realtor, and what happens if you decide to buy. It protects both you and your realtor and ensures you have someone fully committed and to advocating for your best interest throughout the entire process. Next is, can you work with more than one agent? Technically here, yes, but once you sign a buyer agency agreement with a realtor, you are then committed to work exclusively with them. With multiple agents after that could cause conflicts. confusion and potential even legal issues. So it's best to choose someone you trust and stick with them. And finally, how do you choose the right one, right? I think this is one of the most common questions that first-time home buyers do ask. You want someone who will communicate well with you, right? Someone who knows your local market, someone who understands your goals and what you're trying to achieve during your home search, and someone who genuinely wants to help you win. I always advise buyers to don't be afraid to ask questions. I always encourage buyers to treat it like an interview because at the end of the day, you're hiring someone to guide you through one of the biggest purchases of your life. All right, next slide. All right. So when it comes to finding the right home, it's just not about the number of bedrooms or the price tag. It's about matching the home to your lifestyle and your long-term goals. Let's break down a few key factors here to consider. First is location. This is one of the most important decisions. You want to think about how close you want to work from work, right? How because not a lot of people want to drive more than 10 to 15 minutes to work. School district, if you have kids, you want to be in a good school district. Grocery stores, parks, and daily conveniences all matters. A great location can boost your quality of life, right? And also add value to your home over time. Size and location. I always tell buyers to think beyond today, right? So, will this space, right? You always want to think about, will this space still work for you in a few years? Considering the number of bedrooms and bathrooms, right? Of course. But also, how does the space flow for you? Do you want a open layout or a finished basement or a separate work from home space like an office? These are things you want to consider. And next, we'll talk about style and features. Everyone has a different vision for their home, whether a concept with a big backyard. Think about what features that truly matters to you, both inside and out. And then neighborhood, finally, neighborhood considerations, right? It's very important. And you want to do your research here. Like I mentioned, you want to look into the school district, district ratings. If you have kids, you also want to look into crime statistics, right? You don't want to move into a high crime area. And overall, the vibe of the community of where you're planning to look. I always say, if you are looking at a home where or area where you're thinking about moving to, I always advise to drive through that area different times of the day, right? Try to talk to neighbors if you can, and think about how well the area fits your lifestyle and your goals. But yep, and then next slide. All right, so now um, let's talk about the home buying process here. There are 7 main steps you can expect throughout the process. Step one is the pre-approval, which Johnny went over. This is where everything starts before you look at a single house, get pre-approved by the lender. It tells you exactly how much you can afford and shows sellers that you are a serious buyer. Step two, once you get pre-approved, we'll start the home search. This is where the fun begins, right? We'll work together to define your home criteria, things like I just mentioned, location, size, budget, and must-have features. And then we'll start touring homes that fit your lifestyle. Step three, once we find that home, we'll be making an offer. We will put in a competitive offer, right? And then I'll help you or your realtor will help you guide you through decide on price, terms, and contingencies, and then we will negotiate on your behalf to get the best deal for you. Step 4, once we put in the offer and it gets accepted, we will celebrate for a second, right? Because you're halfway through the process. Then we'll get to work. We will then, this is where your lender will come into play here as well. We will open escrow, right? We will start the title search and coordinate. Your lender and your realtor will coordinate all the steps to keep the deal moving. Step 5 is the home inspection. This is where you will hire a professional inspector, right, to come check out the home, the structure of the home, the systems such as the HVAC, water heater, electrical system, and the condition overall of the house. This protects you from unexpected repairs and gives you a chance to renegotiate if any major issues comes up along the way. Step 6 is the final condition appraisal and clear to close. So at this point, you are almost there. You'll provide any final documents to your lender. Your lender will check your finances again at this point. The home will be appraised by the bank. And once everything checks out, your loan is then approved and we will be given the clear to close. Step 7 will be closing day, right? The final step. This is the finish line. You will sign the final documents. Funds will be transferred in this process to the seller, and then you will receive your keys to your new house. This process, these 7 steps may seem overwhelming at first, but when you break it down into these steps and have a strong team supporting you, it becomes very manageable and even exciting. All right. So when we think about buying a home, most people focus on the mortgage payment, and that's definitely a big part of it. But owning a home also comes with a few ongoing costs you want to budget for. Let's walk through them here. First is property tax, right? These are annual taxes based on your home value and your local tax rate. They're typically rolled into your mortgage payment if you escrow them together. But it's important to understand how much they are. Usually, you could find out from your realtor or your local state or county records. Because they can vary a lot by city and or county. Next is homeowner insurance. This protects your home in case of a fire, any theft, storms, or liability. Most lender will require you to carry insurance if you're financing, and the cost depends on the home, size, location, and coverage options. And then we'll talk about maintenance and repair. Just like a vehicle, right? A home needs regular upkeep, like furnace checkup. There's gutters cleaning that needs to be done, landscaping. You also want to set aside a fund for unexpected repair, like replacing a water heater or fixing a leaking roof. I always advise a good rule of thumb is to budget 1 to 2% of your home's value each year for maintenance. And finally, there's interest rate, right? While this isn't a expense you pay directly each month, it affects how much of your mortgage goes towards interest versus your principal. If rates go down after you buy, quite a bit, you might want to consider refinancing to a lower to lower your monthly payment or shorten your loan term. So being aware of these extra costs helps you plan ahead, right? Stay financially comfortable and truly enjoy your home without any surprise expenses. All right, so we are getting there to the end here. So first off, right, just want to say congratulations for you just taking a huge step by learning what it takes to become a homeowner. I know the process can seem long, sometimes overwhelming, and filled with unfamiliar terms. But here's the truth: what if with the right supports and the right people guiding you, it becomes not only manageable, but it becomes exciting. Everything we talked about today, from understanding equity to tax benefits to financing, house hunting, and closing, it's all part of helping you build something powerful. Like we talked about stability, freedom, and generation wealth. Homeownership. Yep. So let's see here. Yep. No, you're good. You could go down. Yep. So again, before we wrap it up here, I just want to say thank you so much for being with us today. If you're ready to take a next step, me and Johnny is here to take any questions that you may have. Um, our contact information is listed here. If you have any questions that you may want to ask now, we'll take it. Or if not, take our contact down and feel free to reach out to us, and we'll be happy to answer any questions that you may have. All right. Thanks, everyone.
All right, we got a question in the chat. Thanks. Great job, guys. Peter says, what is the average home buyers usually look at? Average home price, Peter? Is that what you mean? How many? How many homes do buyers look at? So meaning like probably how many homes does a buyer tour usually before they buy a house?
So it really depends on what you're looking for, right? I have worked with buyers where they took anywhere between 3 houses to 20 houses. So it really comes down to your criteria of what you're looking for. If you're not nitpicky, it could be really quick. Like I said, you wanted 1 to 3 homes. Looking for a lot of options. It could be, you know, up to 20 houses. It could be a couple months, 4 to 6 months before you find a home that you really that really matches what you're looking for.
Sounds
Yeah,
good.
I'd like to add to that. So I think on average, my clients are doing somewhere between 10 to 15 homes before they buy. You're gonna have clients, like Seng said, that they go look at three and they're like, yeah, I'm good with this one, and they buy it. And then you're gonna have those that, which is rare, more rare. You're gonna have those clients that takes a whole year, right? And what I mean by and maybe even longer, right? Some of them, what they do is they come in, they start looking at houses, they realize that it's too much for them. They need to save up a little bit more. So then they're like, you know what, I'm gonna wait a year, right? And then they come back a year later, right? And then they buy a house. So it's gonna vary on the client. Like I have some clients currently right now that they came to me and they're like, we want to buy a house. And then not too long after that, they're like, oh, we signed a contract for our rent to continue for another year. And so we're gonna wait, right? And I was like, so housing prices are gonna go up. Just so you know, like based on supply and demand right now, there's still a large demand for homes. However, I can't, predict the future, but if it so happens that we come across something good, then I'll let you guys know, right? And I did tell them, hey, when you're 6 months out from your lease expiring, that's when you need to talk to me. That's when we need to get you pre-approved. That's when we need to get everything set up and ready. The pre-approval process, might only take like a few days or maybe a week or something like that, assuming, your loan officers aren't super busy, right? Because if they are, it might take a month. Um, but let's say they're not that busy. They get it to you within 2 days. We got to start looking for houses. It might take you 3 months to find one that you like. And then it takes a month to go through the loan process and to go through the closing process, the due diligence process, right? Doing your inspection on your home, getting the finances ready, getting appraisal done, getting the title search all put together, getting all your documents over to underwriting. It might take, it usually takes up to about 30 days, right? Now, some of us can do it faster, right? We've done like for me, we've done like 3 days, right? Which is outside of the norm. That means you gotta have your stuff like ready. Anytime I call you, you better have that stuff ready, right? But the average for Win-Win Financial is about 2 weeks, right? We normally get your stuff done in about 2 weeks. But we still ask for a 30-day contract, which means that because the honest truth is your realtors need time to be able to renegotiate if something comes up on the inspection. If something comes like if the appraisal comes in low, we need time to be able to research that stuff. So it might take the full 30 days. So we ask for the full 30 days on your contracts. So if you're looking at it from it takes you 3 months to find a house, it takes you 1 month to get the loan. That's minimum 4 months, right? 4 months. And so usually I tell my buyers that, the ones that aren't ready, hey, when you think that you're about 6 months out to purchasing a home, you need to reach out to me. We need to have those conversations and get you all prepped up and ready, get your down payments in the right spot, get everything organized and ready to go. Sorry, long-winded.
Oh, yeah, good point there, Johnny. So yeah, again, and I just want to add, right? It just depends on what time of the year you're looking for houses as well. Usually spring and summer usually get very competitive, right? So if there's a lot of buyers out in the market and that are searching as well as you, you're going to be forced to compete with other buyers. Fall to winter it kind of dies down, but nobody's really selling in the wintertime as well, so there's not much inventory. Yeah, it all depends. A lot comes into play when you home search, but as mentioned, if you have a good realtor working with you, they should be able to help you secure a home that you want. Yeah, if there's not any other questions here, we could end it here. And then again, if there's any questions later that you might have, again, you have our contact here. Feel free to reach out to me or Johnny, and we'll be happy to help.
So I have a question. So the market is really competitive right now in both Wisconsin and Minnesota, that I know of. And to kind of piggyback off of Peter's initial question, how many houses are buyers looking at? How many offers are your buyers losing out on before they actually win something? What are your averages right now that you're seeing?
I'm seeing about three. The first offer is always, like my clients come in, the first offer is always just the fair offer. It's not the it's not the offer that's going to win the bid. It's just they're usually trying to gauge the market. And so they just put in a fair offer and usually they get outbid, right? Because there's going to be buyers that are in the market that have been looking and they're frustrated and they just want to get in the house. They're going to bid higher, right? Um, and the second time, usually it's also another fair offer. Um, but you run into the same thing. The third try, right? Usually the clients are like, okay, I think we're pretty serious now. We found the house that we really, really like, and we want to put in a aggressive offer. And when that happens, so usually we look at doing different things, right? A lot of times us as realtors, right, we'll call the listing agent and say, hey, how many offers do you have, right, on the table? Or hey, where are we at? What are you guys thinking? Like, I know that you guys have the house price at this amount. We ran, CMAs. This is where we think we're gonna come in at. Do you think our offer, if we came in at this number, is it gonna work, right? And if they blatantly say no, then it's almost like there's no point in even setting in the offer. And although there may be no point, we still send in the offer anyways to see if they're just pulling strings, right? So we do our best to try to coach you, try to give you advice. And the thing is that until they get really serious, their offers usually don't win. And so once they get really serious and they put in an aggressive offer, usually that's where we win the offers, right? Now, as realtors, we also list homes, right? So when we're listing homes, as realtors, we're looking for certain things. Like recently, I had an offer on one of my houses and we had to decline it because it didn't meet all of the needs that we needed. For example, we called up the loan officer and the realtor, the buying realtor told me that they were using a down payment assistance. The loan officer, when I talked to him, he said that the down payment assistance program is not approved yet. And so that's not going to work, right? You got to get your stuff in line. And, oftentimes, like, there are going to be people who are not familiar with the process. Even some loan officers and some realtors out there, they're not familiar with the process. So it can complicate things during the process if they don't know it that well. And of course, we have plenty of examples, but, we always wish for the best. And, move our clients towards that direction. So yeah, so again, long-winded, but two, yeah, two, three offers is where we really get like after two or three, loses, then on the fourth try, usually we get the offer to go through.
How about you, Sang? What are you saying?
So a few houses that we have been competing with, I would say early spring here, we are seeing. I had one that had 10 offers. We put in an offer where we were the highest offer and we still didn't get it because like Johnny mentioned, right? It just didn't meet what the seller's looking for, even if the your price is high. So I mean, it really comes down to how you can convince the seller to to um, to take yours at the end of the day. And again, it's all about strategy and yeah. So I mean it. Yeah, I've seen about 10, 5 to 10 average is what I'm seeing. So
Wow, 5 to 10. Dang. Okay. All right. Yeah, I'm seeing about the same, like about 3 to 5, probably. Kind of similar to what Johnny mentioned. The first couple offers are kind of just buyers filling out the market, right? As realtors, we're pretty much just consultants, right? And it's up to buyers to trust us. And a lot of times in the beginning, they may not exactly trust us right away. And so it takes a couple times to lose, and then you realize, oh, wow, the market is really competitive. I got to step up my game, right? Instead of it is what it is, or if it's meant to be, it's meant to be, right? There's a lot of buyers like that. They find out real quick that, oh, it wasn't meant to be. And then sometimes, of course, the terms and things like that do really matter as well. Um, Sometimes you just get unlucky and you get beat out by cash. You get beat out by cash, quick close, no inspection. Those things are really hard to compete with, right? There's nothing you can do. Um, so let's talk about rates for a little bit, since that is the hot topic, right? So Johnny, you're the loan officer here. What do you see in your crystal ball? What do you see for rates for the rest of the year?
So so no one knows the future, right? But my personal crystal ball says that rates are probably going to be pretty stable for the rest of this year. You probably if you're going to see a movement up, it won't be so significantly increasing. If you're going to see it come down, it probably won't be so significant. My thoughts are if you need to buy this year, just buy. It doesn't matter where the rates are. The thing is that as rates go down, of course, you can always refinance, right? So my thoughts are is that, of course, you don't want to refinance right away, but you want to get to a position where you have the house that you need to be able to live the lifestyle that you want. And as long as you can qualify for the payments, it's not so much about the rate, but it's about what you as an individual can afford, right? Which is the monthly payment, right? Can you handle that monthly payment? But yeah, like recently rates ticked up a little bit. They went back from I think we were at 6.5. They went up to about 7% right now. So we saw it increase at about 0.5%. If you want to pay additional points, you could probably drop it back down. But my recommendation is just go ahead and lock in wherever it is today, because in the next 3 to 5 years, I see rates dropping. So that's just my opinion, my perspective. You can't quote me on that because the truth is I can't predict the future, right? But that's what I'm seeing.
I'm gonna hold it you. I'm gonna hold you to that. Uh, I kind of see the same thing actually too. But speaking of refinance, when does it make sense to refinance?
I think when you can save about 200 bucks a month, that's a perfect idea to go ahead and do the refinance. Um, if you get to a point, because there's a cost to refinancing, right? A lot of people don't think that there's a cost involved because we roll it right back into the loan, right? The all the closing costs and everything like that. But it can cost anywhere, between $3,000 all the way to 10, depending on the value of your home, right? If you have $1 million home, you're going to be paying more for closing costs, right? So the thing is that you want to be able to offset that, and the hopes is that you can offset it in the next like 2 to 3 years, right? And that usually is a $200 per month payment in order for you to catch up. And in the next 2 to 3 years, you would catch up. And then from that point on, there'll be savings, right? Because you're actually paying for the closing costs. So that's my opinion. Everybody has their own opinion. I think, when should you refinance? When it's best for you is the real answer. Sometimes you got to take cash out, right? Because your current interest rate on your credit cards, like let's say you got $50,000 in credit cards, your current interest rate on your credit card is 20%. Hey, let's do a cash out refinance, get you in a better position, right? You're going to be saving way more than 200 bucks per month in interest. Yeah, that's something that you might want to do. However, if all you have is your mortgage and your interest rate is 3%, you might not want to refinance anytime soon. So it's scenario based from my perspective.
Got it. I agree with you on the recapture, right? How long is it the savings going to take you for you to recapture the cost to refinance, right? So if it's a short period of time, couple years only, then it might be worth it. If it's going to take you 10 years, maybe not. Let's talk about, so this is a first time home buyer, but we also have other people watching, maybe people who already own a home right now, and they have a low interest rate, right? They have something under a six. Um, what's your opinion? Do you think it's worth it for them to sell and then rebuy in this market?
Saying you want to take that one first?
Sure. I mean, if it depends. If you are looking, it depends on your situation, right? If you are looking to upgrade or downsize, depending on your situation, and where you have enough equity within your home, I would say chances are um, definitely do it. But if you are in a good spot and you just looking for a next home, I would definitely hold off and see where that interest rate ends up um, in a year or two, and go from there. So
Yeah, so I'll pick up where Sang left off. I agree with Sang. It depends on your personal perspective. However, me as a real estate investor, my perspective is going to be a little bit different on all that stuff. I think that if you can keep your property and rent it out, that's what you should do. And the reason for that is if that interest rate is that low, to keep the house, rent it out. And then if you want to draw additional equity, get a home equity loan, right? Get a home equity loan, use that on the new house. You don't have to sell your house. You don't always have to sell your house to be able to move on. However, like if you feel that you need to sell your house, then to move on, I actually think that it's a really, really good idea. If you want that dream home today, right? And again, I don't have a crystal ball. I don't know the future, but based on how everything's looking with the supply and demand chain of housing and the amount of people that are going to be coming out on the market, I think that if you want that dream home, you better get it today. Otherwise, that same home is going to be twice the price in the next, like, I don't know, 10 years, right? So when you're looking at, the increase in cost of housing, the increase in, building, the all these different things, it's probably better if you just go ahead and make that move today than to wait if you're still looking for that dream home. If you're downsizing, you probably can wait a little bit because, like Sang said, if you're downsizing, you could probably wait a little bit until the interest rate is a little bit more comfortable. Um, Unless the housing expenses is just too much, right? Your utilities, your taxes, all that stuff is just too much. And it'd be better for you to go ahead and buy a smaller house, even though the interest rate is higher, then that's what you need to do. In addition to that, as an investor, interest rates don't impact us so much because we can write it off, right? So most of the times, if you're an investor, let's say, for example, if you're just, a mom and pop starting, just purchase your second home that is your dream home, and now you got a house out there and you want to rent it out. Now you can claim it's like what Sang said earlier on our slides. You can claim depreciation, you can claim repairs, you can claim all these different things on rentals that allows you to offset your taxes. And if you make pretty decent income, like if you're a doctor or a lawyer, you're going to need that anyways, right? So I just recommend that you just go ahead and keep it, if you can. And if you can't, go ahead and sell it, make the move. If you think that you can live in your house forever and never have to do this ever again, which I mean, I'm gonna be honest, most people don't do that, right? But if you can, because there are like a very few amount of people that can actually stay in there and live in there forever, keep that low interest rate. Uh, Pay the house off as fast as possible and put yourself in a better financial position, right? That would be my suggestion for you. But everybody's scenario is going to be a little bit different. But I do think that if you still want that dream home, you better get it today before the $500,000 house becomes $1 million, and then now you can't afford it, right? So that's just my 2 cents.
All right, great points. Great points. I definitely agree that prices are not going to stay the same. Prices are always ever increasing, right? And Maya Miller just entered the chat on Facebook here on our Facebook Live. She wants to know, Johnny, her question is, what is today's rates?
So I checked for one of my clients, 700 plus FICO score. I think it was 20% down today, and we were at 6% with one origination point. And one origination point is pretty much what all lenders quote rates at. So you're at, sorry, it's at 6.99% to be exact, right? 6.99%, so right around 7% for conventional. It's a little bit less for an FHA loan, but of course, FHA comes with possible repairs. Peeling paint, for example, is one of those things that you have to, if the house has peeling paint, then that has to be fixed. In addition to that, we're looking at, a cost of upfront MIP of about 1.5, oh no, 1.25%, I think is where it's at right now. So um, I think that if you paid 1.25%, the rate would probably be a little bit lower on conventional. But I think FHA is right around 6.5 right now. And so um, every scenario is going to be different. Everybody's going to run into a different rate quote because everybody has a different credit score, a different DTI, a different LTV, right? So different amounts of down payment. The more money you put down, the better it is. So that's kind of where average rates are. So hopefully that helps.
All right, thanks, Johnny. So you mentioned something pretty important, FHA. We didn't really talk a lot about the differences between FHA and conventional. Sang, do you want to take that question? Like, you know, is one better than the other?
Um, well, again, here it really depends on your situation, right? If FHA, if you have a lower credit score and you are looking for a lower down payment, I would say go leans towards FHA. But it is not a lot of sellers like to accept FHA as financing from buyers. right? Just because when it comes to appraising the property, they're pretty nitpicky at things. Um, just smaller things like peeling paint, right? So a lot of sellers don't really like to accept FHA, but again, this depending on your situation, if you have to, you have to. Typically, I would go lean towards conventional, right? Just because it's more acceptable with sellers in the market. It sometimes it depends on your credit score, and it might you might be required to put a higher down payment with conventional, but again, conventional I would suggest is better, probably one of the better routes to go with.
Anything you want to add, Johnny?
Yeah, so I'm 100% in agreement with Seng, right? As a listing agent, right? When I have houses out there for sale and I get two contracts in and they're the same price, pretty much everything's the same, but the difference is one's a FHA and one's a conventional. We're likely going to go with the conventional transaction. And the reason is because we know we're not going to have to run across repairing something. We know that the appraisers are a little bit more lenient, so they might allow the pricing to be or the value to be a little bit better, right? And so even though they might be using the same comps and everything, FHA appraisers are a little bit more nitpicky, right? And has a little bit more guidelines that they have to go through. Say, for example, if you don't have smoke detectors and you don't have CO2 detectors in the right place, or if you don't have there's just some chipped paint outside, right? That's deteriorating, that has a little bit of deterioration on the paint and it's just coming off. FHA is going to want you to fix all those things, right? And that means that you're going to be running across your clients are going to be as a listing agent, right? My clients are going to be running around fixing those things, or I'm going to be running around fixing those things. And so that being said, we try to take the best case scenario for our clients, which usually is going to be conventional financing. Of course, cash is king. You come in, you show me a bank statement, right? Proof of funds of $500,000, dude, we're gonna be working with you. But if you have financing, I'm gonna definitely say that number one, we'll take conventional first. Number two, we'll be willing to take VAs, right? And then number three would be FHA, and then FHA maybe down payment assistance fall below FHA and all that stuff because we know that they don't meet the minimum income or asset requirements, and so we'll be taking less of those. But of course, it also depends on the price point of where your house is, right? If you're in, for example, if you're in North Minneapolis, the house is 250,000, dude, we're pretty much going to take the best case scenario, like the best case offer, right? The highest price that's offered, and hopefully everything works out. But I'm gonna be honest with you. Anything over $350,000 with my clients that I've worked with, we usually wait until we get, a decent cash or conventional offer.
All right, great points there. So what I heard a lot from tonight from you, Johnny, is that you know, as a buyer, right? This is a buyer webinar. You kind of have to think of your offers when you're looking at homes from the standpoint of the seller, right? If you really want your offer accepted, you have to put yourself in the shoes of the seller, right? However, you can make your offer stand out and be as simple and smooth and meet what the seller wants, right? You have the best chance, right? Aside from cash, which Johnny says is king, and which it still is, and no inspection, right? No inspection is pretty much gold these days because it's basically you're just going straight to closing if it's cash or appraisal if it's finance. Um, Now that is a question that we should probably cover. Um, in a competitive market, we are seeing a lot of buyers waive inspection. What is your guys' stance on that when advising clients?
So yeah, so usually I do not recommend waiving home inspection, right? Just because you're giving up a lot if you're waiving, and it depends on the situation. If you find a house where there's a lot of competitive offers, I think that's the only reason that we will want to waive inspection, just to compete. But most of the time, if there's not a lot of buyers in a house that you are wanting to put an offer in, I usually recommend to get an inspection at all costs. Again, it's going to be additional costs to get an inspection, but again, it gives us a chance to see how the condition of a house is. And again, as I mentioned earlier, it gives us another level of protection where we could renegotiate with the seller to get things fixed if needed, or if anything major that pops up along the way. So yeah, at the end of the day, I don't recommend waiving inspection unless you're really in a high competitive um, situation where there's a house that you really like, but there's a lot of offers, and you do really want the house. Then yes, maybe you kind of have to take the option of waiving it. But like I said, most of the time, I never recommend to waive the inspection on a house.
Yeah, so I think that it depends on the circumstance, right? So when it comes to inspections, if it's a 5-year-old house and we walk around and we test everything, right? So I recommend testing everything yourself. So like if one of my clients really wants to make an offer and it's a 5-year-old house, and I've checked out the furnace, I've checked out, and like, because I'm an investor, right? So I have to replace these things on my own properties, right? So I kind of have an idea of when they're gonna go, and at least have an idea of, like, say for example, the lifespan of a water heater is approximately 10 years. So if the water heater is over 10 years and it's running fine, we might leave it. But if you're starting to see rust on the outside and weird things going on, then of course we want the inspection, right? But if it's a 5-year-old house, and this is just an example, right? It's a $500,000 house, 5 years old, water heater looks brand new, the AC and furnace looks brand new. Um, all of the, like, pretty much the roof looks brand new, the windows look brand new, and everything just looks in really, really good condition. You can tell the seller's taking care of the whole entire house. The only thing that I worry about is going to be the sewer. And so what we do is we actually run water, right? We'll go back before we make an offer, and we'll do a 2 hour showing, and we'll run water for 2 hours to see if something goes wrong, right? And if nothing goes wrong, we put in an offer without inspections, right? So have I done that before? Yes, absolutely. Do I recommend it? I'm gonna say I always recommend an inspection. However, in a case where we just won't win the offer and we've checked everything, done our due diligence, right? On the main five expensive things: the water heater, the furnace, the roof, the windows, and then the sewer, then I would say, hey guys, we've checked all the main things that are super expensive. Seems like the electricals are working just fine, right? Um, do you want to put in an offer without an inspection? Because if you do, and we put in a decent offer, you're likely going to get this transaction. In those cases, and only in those cases, will I ask them, do you want to do this? I don't recommend it, but do you want to do it? If you do, then we'll make the offer, right? So that's kind of my stance on it.
Awesome. Wow. So yeah, I mean, if you watched in the call, man, Johnny just dropped some top secret stuff here. So yeah, I'm not gonna spill it again, but go back and watch it. But myself as an agent, I always recommend buyers to do an inspection. If they want to waive it, it's up to them. However, there are ways that we can try to negotiate an inspection in and still be competitive. But of course, if somebody else is waiving their inspection entirely, then it's pretty hard to compete with a no inspection at all. So that is going to be it for the night. We're at 9 o'clock here. We're not going to keep Johnny anymore. It's actually his birthday. So if you guys want to wish Johnny a happy birthday in the chat here, um, you know, feel free to type that in there. And if you want to play a game, guess Johnny's age. Put that in the chat, right? Closest person to his age, we'll send you a $10 Starbucks card or something like that. Only good for the next hour though. Okay, so hurry up. All right, guys. Anything else you want to say before we sign off?
No, I just want to again thank everybody for joining us tonight. And yeah, if there's anything that me and Johnny could help assist with anything, like I said, feel free to contact us. And we're both in Minnesota, so yeah, feel free to reach out to us.
Yeah, Sang and I have partnered up. We've done deals together. Sang's awesome. Uh, I'm I'm super old and been in business for a really long time. Done thousands of transactions. So like you name it, if you have questions, reach out. We'll definitely answer them. And if we don't, we know people like My Miller, right? That can help us out with some questions and stuff like that. We are very well connected in the community. So just reach out if you have questions. We're here to help.
All right. So Don Hyung in the chat says, Johnny, you're 21 years old, correct? You've only been in the business for 20 years, and so you got to be 21. And then Peter says 38. But yeah. All right, man. We're not going to keep you out anymore. I'm sure you might have dinner plans with Tina, so she's probably mad at us. But thank you so much for spending your birthday night with us to talk about real estate. That just shows how much you love real estate and how much you're willing to help out. If you guys have any needs for real estate in Minnesota, reach out to Seng Thao and Johnny Vang. And that's it. We'll watch out for our future webinars coming up. So have a good night. Bye.